Palisade Radio is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back, everyone, to another episode of Palisade Radio. This is your host, Colin Cattell. On the line with us today is Ravi Sood. We had Ravi on the show about a year ago to discuss metals and mining amongst other topics. And for our most ardent listeners, you may have heard our interview with Rick Rule in April, where Rick stated his enthusiasm at getting behind a top financier such as Ravi Sood, Lucas Lundin, or Ross Beatty. Certainly high praise from a guy like Rick, and all the more reason you should tune in and listen to this exciting program today. Ravi, thanks for coming back on the show.
Thank you, Colin. Always a pleasure.
Ravi, you're the chairman of Transeastern Power Trust, which is a renewable power trust. We're going to talk about that a little bit later. But I want to stage the conversation today around renewables. And this isn't going to be an idealistic discussion about changing the world. That's certainly a day that we all look forward to, and the world can be run off of the power of just sun and wind alone. But I want to stage a business conversation today and find out what the hurdles are to getting to that point and how far off we are. The first thing that I want to ask you, Ravi, is about the oil price drop that we've seen over the last year. That certainly had some effect on fuel costs and other forms of power generation. Has there been much of an effect on the renewable space?
Yeah, really, there's been almost no effect, and there's a specific reason why, Colin. It's because very little oil itself is actually consumed in the generation of electricity. At today's prices, yes, it would be competitive to use oil in many cases and burn oil, even though there's a very low conversion ratio, so that you lose about 50% of your contained energy by burning oil to generate electricity. But the reality is it's a very small market, and so the renewable drum has continued beating, and the rollout of renewables has continued unabated despite the drop in oil price.
And so I guess what you're getting at there is there's an upfront construction cost to building any type of a renewable situation, whether it's wind, solar, or hydro, but your operational expenditures moving forward, there's no input of oil, it's simply maintenance. And so once something is built, the power that's generated from a renewable site continues moving forward and isn't affected. To that point, I want to ask you, start out with solar, wind, and hydro, and what the costs are, generally speaking, worldwide, on what it costs to sell power from those three sources.
Yeah, absolutely. I think that's a very important thing to understand for anybody looking at renewables or looking at how they interact with things like coal, gas, and ultimately even oil. There's differing views, but they're all centered around similar numbers. The prices for building renewables, the costs plummeted in recent years for obvious reasons, particularly solar, which was by far the most expensive and has had the sharpest move downwards. But you're looking at an all-in, fully loaded cost. Remember, this is almost entirely amortized CAPEX. So costs that you've taken in up front and are amortized over the life of your operation, because your operating cost, your input cost with renewables is next to nothing. You're running off water, you're running off wind, you're running off the sun. So you start at the low end. The least expensive average for hydro is about 8 cents per kilowatt hour. We're talking in U.S. dollars here, of course. Solar has come down precipitously. The range there is about 10 to 12 cents. And then on wind, you're looking at 12 to 15 cents. So that order, hydro least expensive, solar in between, and wind higher. Of course, in different scenarios, the numbers move up and down, depending on your water flow, depending on your solar radiation levels, depending on your wind profile. But it's basically that ranking. And the other important numbers to understand, and it really affects economic decisions here, is how does that interact or compare to traditional forms of power generation? We're talking king coal and we're talking natural gas. And again, in the case of gas, it does fluctuate a lot globally depending on what your input cost is. But in those two cases, you're looking at much of your cost is on your input. It's OPEX, not just amortized CAPEX. But it's still way lower, and we're talking half of the cost of hydro. So you're looking at 3, 4, and 5 cents per kilowatt hour, fully loaded. What's not in that cost? A cost for the carbon or the environmental impact or social impact or what have you associated to burning fossil fuels and releasing whatever that releases into the environment. But straight up economics, The renewable sector, despite the huge improvement in cost and operating efficiency, is still far more expensive than traditional means of generating electricity.
Yep, and Ravi, another interesting conversation we had a while back is that there's two factors in how a power plant or a wind farm or a solar farm gets paid out. And you told me that, just because a wind farm is rated to put out 5 megawatts doesn't mean that it's actually going to get paid the same as a coal plant putting out 5 megawatts. What are the factors that are brought in when figuring out how much something's going to make for power?
Absolutely, and so it's not an apples to apples. People quote typically when you're talking about power plants, how many megawatts is it? What's your capacity, installed capacity? So it's there's more to it. That's the case. That is an apples to apples comparison. Typically, when you're talking about coal or natural gas, because if you so desire, you can run it full out all the time. You could have feedstock available. You can keep running. You could have near 100% capacity utilization.
And Ravi, one thing that we spoke about a little while back is the different factors that go into play when you figure out how much the power you're generating is actually being bought for. So, for example, you were saying that a wind or a solar farm, which obviously isn't going to be generating power all night or when the wind isn't blowing, even though it's generating the same at peak power, is going to be getting a lot less money than something that can provide a base power situation. Can you talk about that a bit?
Absolutely, and it's an important thing for people to understand when they're looking at investing in power, investing in renewables in particular. So we need to talk about actually three things. What's your feed-in tariff? What are you getting paid per kilowatt hour? And in many jurisdictions, you get a premium price, and you need that premium price in many cases for renewables, for green power. Number two is capacity factor. And the capacity factor, another term we could use for that is utilization factor. So a wind farm, on average, is going to see 20 to 22% utilization rates for an onshore wind farm. It's not going to be windy enough 100% of the time. A coal plant, however, you could be running 100% of the time. So again, that is a lot of the reason for the difference in costs. Solar, you're going to do a bit better. Typically, 25% is a good rule of thumb. And hydro, better still, typically about 50% for run-of-river hydro, 40 to 50% anyways. So you got to look at all those numbers. What do you get paid for the power? What is your capacity factor? So how much power you're actually going to generate? And the third factor is what's called balancing. And in many cases, most cases, you do lose some of your revenue to cover what are called balancing costs. And what are balancing costs? Well, if I knew exactly when the wind was going to blow, my wind farm would turn and I would generate electricity. I would know when to sell it. If I have an offtake and I have a wind farm, I can't tell the person who's buying my electricity exactly when I'm going to give it to them. So they have to take on that risk. And for that risk, they charge a cost, or different intermediaries charge a cost. And that's called the balancing cost. And it's a significant factor to look at. It's just a reality of renewables, and it's another one of the inputs. But again, it speaks to, you can't make an apples-to-apples comparison between 5 megawatts here and 5 megawatts there. You have to understand, what are the balancing costs, what's the feed-in tariff, and what's your capacity factor? How many actual megawatt hours of electricity am I going to produce from this asset?
Ravi, putting aside any type of credits that the government might be giving in order to incentivize people to build these plants, is there a model that you can run, some type of mathematical model that tells us what year in the future technology is going to allow us to produce solar, wind, or hydro at a price cheaper than coal, oil, etc.? Well,
as it currently stands, short of an absolutely miraculous breakthrough, there is no allocation of carbon costs or other environmental costs to traditional generation sources. You're not going to beat coal and you're not going to beat natural gas. Perhaps at someday in the indeterminate future where we've run out of gas or peak oil and so forth, the price of hydrocarbons is going to be so high that renewables will beat it because of the efficiency increases, et cetera. But as it stands now, we're not going to see that in the next 1, 5, or 10 years. That's something that's really a technological leap or a major sea change away from us. In terms of becoming economic on a standalone basis versus prevailing electricity prices, that is something I won't say we could come up with a mathematical formula, Colin, but that is something closer to the horizon for two reasons. Number one, there is continued improvement in costs and operating efficiency, particularly on solar, where just every year it gets a little bit better. It's plateaued a bit. It's come down on the order of 10 to 1. So costs have come down on the order of 90% over the last 5 or 6 years. So it's been a huge improvement, or I should say 5 to 7 years. So it's been a huge improvement in solar, and that rate of improvement started to slow down, but it's getting to the point where it's getting close to prevailing electricity prices. So that's coming from one side. Coming from the other side, we're looking at prevailing electricity prices and the realization that, yes, still most of that electricity that we consume is generated by burning fossil fuels, whether it's coal or natural gas, and in some cases, baseload power from nuclear. And in most places, there's no cost put into that associated to the environmental cost or social cost, and that is coming. We're seeing it coming. So the prevailing price of electricity paid by consumers, individuals, retail buyers, wholesale buyers, industrial buyers, that is going up. So even though we're seeing technological improvements, all these new technologies coming at us, the reality is we've recognized we've generated electricity, we've created power, we've had the Industrial Revolution and beyond, but we've never ascribed a direct cost to the damage done by burning these fossil fuels. And as we do that, we're going to cross an inflection point at some point in the next 10 years. And renewables on a standalone basis at that point will be viable without any additional government incentives or feed-in tariffs.
So up to this point in the interview, I'm thinking renewables definitely are not a very good business, yet I had mentioned that you are the chairman of Transeastern Power Trust, and you found a very, very good business model in a market that is in the renewable space. I'm kind of curious if you can explain to the audience what the opportunity is here, how you found a niche or an idea, and part of it's based off of credits that were put in place, incentives in order to get this ball rolling on solar and wind. And you've created a power trust with huge investors in it. Eric Sprott, Rick Rule put millions into this deal. Several other big people. It's paying a very large yield. Ravi, tell us about Transeastern Power Trust, the idea there.
Well, two angles again, Colin. I'll call it. One is the big picture, and then the second is a more of a micro or bottom-up approach to the opportunity around why this is such a great opportunity. Number one is the return profile of the world. In my view, the world that we're in, we're going to increasingly face long-term returns that are lower and harder to come by. So any assets that can generate long-term, consistent cash yields are going to continue to attract investor interest and continue to be valued dearly and be ascribed high multiples. So we've seen it already with REITs, with different types of MLPs and investment trusts, income trusts in Canada, where they've got very good multiples, excellent investor following, Canada, Europe, North America, everywhere. And I believe that's going to continue to be the case. Renewables fall into that with the proviso that, yes, you are dependent in these renewable assets on government incentives, but the reality is the winds are blowing in that direction. They're continuing to blow in that direction. The likelihood of these being yanked out from under you in very good, high-quality jurisdictions like the EU, North America, Japan, is very low. The fact is we need not only the existing renewables to continue to operate, we need a lot more. And remember, we're talking about the capacity factors. Replacing one coal-fired plant requires a massive investment in renewables, multiples, because of you have a lower capacity factor, you're not going to generate as much electricity. So there needs to be huge incentivization, and that's going to continue. So I'm not terribly concerned about that in the short term, as long as you're operating in reasonable jurisdictions. So very much focused on places like the EU and North America as well. So the second part of it, that's the big picture. The first part, the fact that we're targeting opportunities where we could generate long-term cash yields from stable, low-risk assets, no big investment or no big bet on technology, no big bet on how the world is going to shake out. As long as we keep using electricity, there's going to be a market for our product. The second aspect of it is, I'll call it the bottom-up opportunity. And if this is our big picture, we're going to target these kind of assets, the bottom-up is where are we going to do it? And as I said, A very big focus on jurisdiction, so you want to be in safe places. What's happened in the last many years with Europe, it's fallen completely out of favor. And you have two forces at work. One, you have a marketplace that's out of favor. And second, you have costs of capital that are very low. Half of Europe has negative interest rates. Even in Romania, which is the first country that we've targeted with Transeastern, where we've got a fantastic opportunity ahead of us, interest rates, 10-year interest rates are below 4%. 5-year rates around 2%. So incredibly low rate environment, ability to borrow cheaply and lock in rates at very reasonable levels, and buy on existing operating projects. So we're not taking construction risk. We're not betting on what's the wind profile going to look like really, what's the efficiency of the project going to be really. We're looking at projects that have been built. And because Europe's so out of favor, and the periphery of Europe is even more out of favor, and investor interest has waned over the years, there's a huge opportunity to acquire existing operating projects at construction costs or even below construction costs. And that's important for many obvious reasons. Number one is we don't have to fund and have a big time period and ramp up until we're seeing cash flows. And number two is our opportunity for returns and operating these businesses, not just now profitably while we're the beneficiary of EU incentives, but afterwards, even when those incentives roll off, which is between 10 and 15 years from now, we bought at prices which are sufficiently low, sufficiently compelling, that we can operate these projects profitably forever without the benefit of any incentives. So right now we enjoy them. It's very important to our business. It's a core part of our business. But we'll continue operating these assets even 15 years from now as those incentives roll off.
Yeah, and Ravi, just to reiterate, essentially you're going in and picking up projects that are already built below construction costs or at construction costs, and they're already operating with cash flow, and you've set that up into a structure that's providing a very high yield. In fact, right now, first of all, I should say that I am a shareholder in Transeastern, as is Ravi, of course. And right now, the trust is paying probably around 13 or 14% yield at current share prices. So it's just an incredible opportunity if you're an investor that's seeking a yield situation. And Ravi, I want to ask you, as things move forward, acquisitions, does it make sense to continue to grow the portfolio? At what point does it not make sense to continue to grow?
Well, and that's just it. Right now, one of our, I'll call it our major issue, in fact, is scale. So we are small. We generate electricity from 3 hydro plants and 2 solar parks. We have 30 million shares outstanding and a relatively modest market cap. So the amount of institutional or broad interest that we've attracted is limited. We've got some very smart people like Rick Rule involved, for sure. But there are people who are able to look at these more, call it special situations, a little bit smaller, a little bit earlier stage, and they're able and they're flexible enough to do the work and analyze them and become involved as investors. Our objective, and really critical for us to get re-rated and achieve a much higher valuation and create a lot of value for ourselves as shareholders, is to get bigger. So we're very much intend to continue to grow by acquisition. And Romania, again, as being in the EU, I believe it's now 9th year of being in the EU, was where we decided to start, and it's where we'll continue to be, at least for the next year or 2 years, because of the huge wealth of opportunities there from an acquisition standpoint. One of the key reasons it became a major renewables market was simply geographical. It's incredibly suitable for hydro. It's got the Carpathian mountain chain, so you have vertical drop and you have water. Number two, it's very suitable for wind. It's actually the windiest place onshore Europe, onshore the Black Sea, and the site of the largest onshore wind installation in Europe. And it's also, somewhat counterintuitively, in the southern part of the country, very suitable for solar. So not talking about Mediterranean levels of solar radiation, but much better than, for example, Germany or Poland or anywhere in Central or Northern Europe. So it's attracted well over 1 gigawatt of solar installations, making it a major global market for solar as well. So it is a absolutely perfect place to start in the EU, but discounted as being in the EU and being on the periphery. And number two, an opportunity to get to critical mass in each of the 3 key generation types in one country. And that's important. Look, these are low-touch assets. They're unmanned facilities. But still, it's critical to have mind and management close to where your assets are whenever you're involved in a company operating overseas. Our chief executive is based in Romania. He lives in Bucharest with his family. Our entire operating team is based in Romania, so we've got feet on the ground. We see the deals. We're close to our assets, and we're very comfortable there. So a lot of opportunities to your question or query. Are we going to continue to attempt to grow by acquisitions? The answer is yes, and it will continue to be more of the same existing operating projects that we know what the cash flows and the production is going to be. And for the time being, they will all be focused in the EU or based in the EU, and at least for the short term, we're focused on Romania. So more of the same from us in that regard.
Okay, and one question that is outside of the scope of this interview, but you have a lot of expertise in the space. I just want to ask you about the mining and metals world right now, and the beginning of January has certainly been a roller coaster ride so far for the general markets. Gold's going up a little bit here. What do you think's going on there? Is 2016 going to be a new kind of year?
Well, it's very. I'll hesitate to I like to make predictions without making them time bound, Colin. So eventually I'll always be proven right. So, gold. Look, I think gold is separate from everything else in mining. I will definitely hive it off as a separate beast. I think a lot of commodities are plagued by what may be a multi-year supply-demand issue, where you have demand contraction. And certainly slower, if not contraction, slower than expected growth, while you still have this hangover of a huge supply boom. And we're talking about the obvious ones like iron ore on the bulk side, and maybe even some of the other base metals. But gold is a different beast. It's a currency. It's not an industrial commodity. And it's now been 4+ years. I mean, we really peaked in August 2011, and that was still technically an up year for gold. But since August 2011, we've been going down. So we're well into a bear market on gold. We're now into territory where most producers on a fully loaded and fully loaded basis are not able to make money. And you're talking about even what formerly world-class tier one companies like IAMGOLD operating with costs that are above the prevailing commodity price. They burn money every day the lights are on. So that cannot continue indefinitely. And at the same time, we've seen in January, just in the first few weeks of this year, an escalation in the global currency wars. We've seen China become extremely aggressive and surprise everyone. We've seen huge moves in different countries around the world. We've seen this confusing rate increase cycle in the U.S., which we all have our views on. And of course, no one is sure how that's going to shake out. And in mounting uncertainty geopolitically. The fact that oil price is so low and appears to be trending lower should on balance be good for the global economy. However, it's clearly very, very bad for many states and some of the most unstable and dangerous states in the world. And the likelihood is that will lead to greater geopolitical uncertainty and even beyond uncertainty. I would say it's almost certain to lead to a major escalation in conflict in certain places in the world. And all of this should, on balance, be positive for gold. Will this be the year where we truly see a turning point and we see gold have its first up year in many? I think so. I really do. And when gold does start to move, I believe it will move sharply because there's simply the dynamics of the coiled spring are at play here. When exactly that happens, I'm not sure. But I do believe 2016 is our first year that we see a change in direction, and it's our first up year in many.
Okay, well, Ravi, thank you so much. I just wanted to remind our listeners, Transeastern Power Trust, it can be found on the venture under TEP.UN. Ravi, if you want to provide any contact detail for yourself so that interested listeners can reach out and find out more information, that would be great. And if you have any other points to add, go ahead.
Yeah, the best way to reach us is through our website or directly to me by email, rsood, RSOOD, @transeastern.com. And the key thing to understand about Transeastern is we are committed to continuing to build a diversified portfolio of renewable generation and generate a steady, consistent cash yield for investors year after year. That's our focus, and we're determined to deliver that to everyone.
Okay, Ravi, thank you so much for coming back on the show today.
Thank you, Colin.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?